Be sure to subscribe and hit the like button to stay informed about similar videos. Remember, knowledge is power.
The Springate model is a financial analysis tool that is used to assess the financial health and the risk of bankruptcy of a company. It was developed by Philip Springate and is particularly focused on identifying companies that may be at risk of bankruptcy or financial distress. The Springate model calculates a score based on various financial ratios and indicators. These ratios typically include measures of profitability, liquidity, leverage, and efficiency. The model assigns different weights to these ratios and combines them into a single score. The higher the score, the healthier the company is considered to be. Some of the key ratios and factors that are often considered in the Springate model include profitability ratios. These ratios assess a company's ability to generate profits. Common profitability ratios include net profit margin and return on assets. Liquidity ratios. These ratios measure a company's ability to meet its short-term obligations. The current ratio and the quick ratio, acid test ratio, are examples of liquidity ratios. Leverage ratios. Leverage ratios evaluate the extent to which a company is using debt to finance its operations. Common leverage ratios include the debt-to-equity ratio and the interest coverage ratio. Efficiency ratios. These ratios assess how efficiently a company is managing its assets and liabilities. The inventory turnover ratio and accounts receivable turnover ratio are examples of efficiency ratios. Size of the company. The Springate model may also consider the size of the company, as larger companies may have different risk profiles compared to smaller ones. Once the Springate model calculates a score based on these factors, it provides a benchmark or threshold score. Companies with scores above this threshold are considered financially healthy, while those below it may be considered at risk of financial distress or bankruptcy. It's important to note that the specific formula and weights used in the Springate model may vary, and the model should be used as a tool for initial screening rather than a definitive measure of a company's financial health. Additionally, financial analysts often use multiple models and indicators in combination to assess a company's financial condition comprehensively. If you're interested in applying the Springate model to a specific company, you may need access to its financial statements and a clear understanding of the model's parameters and weightings, which can vary depending on the version or variant of the model being used.
Be sure to subscribe and hit the like button to stay informed about similar presentations. Remember, knowledge is power.